For years, China's economy has been described with one word: unstoppable. Factories running day and night. Massive infrastructure projects. Cities rising almost overnight. On paper, the numbers still look impressive. Growth continues. Trade flows remain massive. Manufacturing dominance is undeniable. Yet beneath that strength, something essential is quietly weakening. China isn't facing a sudden collapse. There is no dramatic crash. No single event to point to. Instead, a critical pillar of the system is breaking, slowly enough that most people don't notice, but fast enough that it can't be ignored forever. To understand why this matters, we need to look at how China's economic model was built. China's modern economic rise began with a deliberate choice. In the late 20th century, reforms opened the door to global markets, while maintaining tight internal control. The formula was simple but powerful: export-driven growth. Low-cost manufacturing, centralized planning combined with market incentives. Foreign capital poured in. Factories expanded. Hundreds of millions were lifted out of poverty. For decades, the system worked because everything moved in the same direction. Investment created jobs. Jobs fueled consumption. Growth justified more investment. The government acted as the coordinator, smoothing shocks and guiding expansion. But every growth model has a hidden dependency. China's depended on confidence in perpetual expansion. As long as growth continued, debt could be rolled forward, inefficiencies could be ignored, and imbalances could remain hidden. That illusion held longer than most expected, until the rise phase began to change. As China grew wealthier, costs increased. Labor became more expensive, exports faced competition. Demographics shifted. To maintain momentum, the system leaned harder on one tool: debt-driven investment. Infrastructure expanded even where demand was questionable. Property became a primary store of wealth. Local governments relied on land sales to survive. On the surface, this created stability. Underneath, pressure was building. The breaking point didn't come from foreign sanctions or trade wars alone. It came from inside the system. Real estate, once the engine of growth, began to stall. Developers faced liquidity crises. Households saw savings tied to assets that stopped appreciating. And here lies the critical break. China's economy relies heavily on confidence, not just from investors but from its own citizens. When households stop believing that property is safe, when businesses delay expansion, when young workers see fewer opportunities, momentum weakens. Not instantly, gradually. The fallout doesn't look like chaos, it looks like hesitation. Consumption slows, private investment retreats. Policy responses grow larger, but less effective. The government responds with familiar tools: injections, regulatory easing, infrastructure stimulus. These measures stabilize the surface, but they don't restore the underlying trust, because the issue isn't lack of money. It's misaligned incentives. Local governments need growth, but lack sustainable revenue. Developers need buyers, but households are cautious. Consumers need confidence, but see rising uncertainty. This creates a loop where fixes buy time but reduce flexibility. History offers parallels. Japan faced a similar moment decades ago. Strong economy, high savings, powerful industry, but a property-driven imbalance changed everything. The lesson wasn't that growth disappeared, it's that growth changed form. China now faces its own version of that transition. The system must move from investment-led expansion to consumption-driven stability. That shift is notoriously difficult, especially in systems built around control and scale. Modern data reflects this tension. Youth unemployment rises while infrastructure continues. Exports remain strong while domestic demand weakens. Technology advances while confidence lags. These contradictions don't signal collapse. They signal transformation under strain. And transformations are where systems either adapt or stagnate. The world often misunderstands China by focusing only on strength or weakness. The reality is more complex. China is strong in production, logistics, and coordination. But what's breaking is the feedback loop between growth and belief. Once belief weakens, even powerful systems struggle to move forward at the same pace. This is why the situation matters globally. China isn't just an economy. It's a pillar of global supply chains, trade flows, and financial expectations. A slower, more cautious China changes everything, from commodity demand to capital flows. And unlike crises that explode, this one unfolds quietly. One adjustment at a time. One policy tweak after another. One delayed decision after the next. 3 conclusions stand out. First, economic strength can hide structural fragility. Growth numbers alone don't reveal confidence levels. Second, debt-driven stability eventually demands reform, not stimulus. Without realignment, each fix weakens future option. Third, the most dangerous economic shifts are gradual. They lull systems into believing time is unlimited. The open question isn't whether China will remain powerful. It's whether the system can rebuild confidence without sacrificing control. History suggests that managing both at the same time is rare. And the future of China's economy won't be decided by headlines. It will be decided by whether belief returns or continues to quietly fade. If you want to understand how global power really shifts, not through crashes, but through slow pressure, subscribe to the channel. Because the most important changes don't announce themselves. They unfold while everyone is still arguing about the past.